And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
And just like that, Luke Smith is here in the studio once again, as if by magic. Good afternoon.
What a shock.
What a shock, absolutely. Now, last week we were talking about the transition to retirement arrangements. In fact, we've spoken about those a couple of times. But we've specifically set aside today to talk about one particular aspect of that transition to retirement set of rules and how you can use it to your benefit. We spoke previously about how you can use it to reduce your hours at work, but you can also reduce your taxes, apparently.
Exactly right. And it's sort of an extension of what we touched on last week. So it was, I don't really want to go back to work. It's January. Oh, my God, how am I going to do this? I'd love to go 4 days. And we went over how to cover a reduction in wages by accessing your super over 60. Today, it's about using that same accumulated super where you're over 60 to use the transition to retirement legislation to then create a funding mechanism, if you like, to maximise your ability to reach the $30,000 concessional limit. Because we need to keep in mind that everybody can put in $30,000 a year, and that includes what comes from your employer and what comes from yourself. And for example, if I had $30,000 in my cap and my superannuation guarantee from my employer was $15,000, that says I have $15,000 of annual space that I can then actively put money into super, pay 15% going in, provided your income is up to a certain threshold. And that generally, from a tax perspective, is much better than the tax rate at your marginal annual amount. So Indeed. If I'm earning $150,000, I'm paying 39 cents in the dollar at the top end of that scale. And it would be a great idea to be thinking about this transition to retirement legislation and say, okay, I've got $500,000 in super. Am I over 60? Yes. Can I access my super in a limited capacity? Yes. Does my superannuation fund offer this facility? And we touched last week on the PSS not allowing you to do this. But if let's say we've got normal super, I can take 10%, which would be $50,000, and I might go to my provider and say one of two things. I'd like to start a pension with all of my balance. Now, if I say that, that means I'm going to need a new super fund, because you can't add to a transition to retirement account once the income stream has been commenced on a regular fortnightly or monthly basis, which an employer would add money to super. So I take my $500,000. My superannuation provider allows me to use this legislation. I complete the necessary paperwork and I say, I would like $50,000 paid into this bank account, please, tomorrow. And your superannuation provider will facilitate that direction. So I now have $50,000 of tax-free money, because I pay nothing taking it out, sitting in my bank account. And I look and say, I've got a $30,000 limit. I've got $15,000 I know is going to come from work. I'll put $15,000 into my account. And then I might look at my spouse and say, oh, the same scenario over here. She's got 15 with 15 of space. I'll use 15 of that, and she gets a deduction of $15,000 against her taxable income. I get a deduction of $15,000 against my taxable income, and I'm only going to pay 15% in this example because we earn $150,000. I've then got a little bit of money left over. Now, what could I do with that money? Could I put it back into superannuation in a new account? Yes. Could I park it in the offset account of my mortgage? Could I pay down a car lease? Could I use it for a personal portfolio and then get some capital growth in my own name? Sure. You can use your money for anything you want, and you have not changed your work hours. You have not changed the days. You have not changed your employment agreement. All you've simply gone to the superannuation fund and said is, I'd like to access up to 10%. Now, we touched last week on the rules. The rules are you've got to take between 4% and 10% where you're under 65. And that use of capital could be a great way to either reduce non-deductible debt or, in this example, maximise the deduction available. Now, we can extend the annual example. If I have $500,000 in super and I take it out, I've now got $450,000. if my balance at 30 June is $450,000, that allows me to then bring into play the catch-up concessional legislation that lets me look back a maximum of 5 years and say, well, how much of my annual limit have I not used in the past? And it might be 5 here, 10 there. You might have $40,000 of space. So on the 1st of July, we've got a new financial year. Our balance is now $450 because we pulled $50,000 out. I take $45,000 out. I put $45,000 into my accumulation fund, my second fund, because I have that space using the 5-year catch-up rule. And now I've created a $45,000 tax deduction on my $150,000 of wages. And I haven't paid a cent in tax taking the money out. So I want people to be thinking about this legislation, not just for I don't want to do 5 days a week, because there are some huge tax benefits on the table if this strategy is used on an annual basis between a couple or as an individual, or if you were to get the balance of your super under 500,000 and you have room in your cap space, be thinking about the catch-up room that you could have, which is just simply the annual limit minus what you used in the 5 previous years. Add all of that up. In our example, if it was 45,000, I could say on the 1st of July, give me 45,000, put it straight back into my accumulation account and claim a $45,000 tax deduction in that financial year. And there's nothing stopping my spouse from doing it as well. So this is a really, really good way to think about your super as a funding mechanism for other strategies, because everybody loves a tax deduction.
Well, they do indeed. And it was explained to me that you can also do a similar thing, and tell me if I'm wrong, but I think this is getting to the same destination by a slightly different road, but you can involve your employer and ask your employer to put salary sacrifice payments into your superannuation. So that's pre-tax money going into your super. It gets taxed at the super rate of 15% instead of your marginal rate that might be 39% if you'd still taken it as salary.
Spot on.
And you can make up the difference with your transition to retirement money coming out of the super fund, which is coming out completely tax-free. So you don't need the whole $15,000 to get the same benefit that you would have had from your salary.
Exactly right. None of this is used in isolation. You can do both sides of that. I'm going to go to my work and say, all right, I'm going to salary sacrifice over the course of a full financial year. Then you might not need the transition rules. Where the transition rules become in handy from a timing perspective is that you may not be able to salary sacrifice. Let's say you came across this strategy in April. You probably, or you may not be able to salary sacrifice enough of your pay to get that $15,000 into superannuation. You might start it when you find out and go, oh, I can salary sacrifice some money to super in April and do 1,000 in April, 1,000 in May and 1,000 in June. Then we can turn around and say, all right, let's use the transition to get the pension out to top up the 15, taking away the 3 that we salary sacrifice. So it's a great way to build in multiple strategies, because at the end of the day, all we ever want is for somebody to get the best strategic outcome using the legislation that's available, as well as the comfort that people have with their cash flow. Some people don't like doing it as a lump sum at the end. Other people are more comfortable with out of sight, out of mind. I'll get my work to do it from the 1st of July and I'll do it over the financial year. Then I don't need to touch my super. Other people go, well, I'd rather have control of my money during the year and do it in June because I could do A, B, and C with other money. So regardless of how you get there, I think it's great that people think outside the box the best they can. And just remember, it's an annual limit for all forms of employment. I had a lady argue with me in December that she was going to do 15 for that job and 15 for that job. And I just begged her not to, because there were going to be tiers and they weren't going to be mine. Because she was adamant that the ladies at Mahjong had told her that, no, it's $30,000 per job. I was like, well, okay, you can leave here and know the rules, and I'll leave that with you. But make the most of these types of strategies, because they're great ways to manage cash flow and a great way to then use, especially even if you max out your caps, a great way to pay down mortgage, non-deductible debt, HECS, anything else that is going to eat into personal cash flow that may not be deductible. The transition to retirement legislations are a wonderful peace of mind vehicles.
So effectively, there are two benefits, aren't there? The one is that you're boosting the balance in your super fund by making the additional contributions. And the second one is you're getting the benefit of those tax deductions.
That's right. And even if you think about it, people say, oh, but it's going to go down. Yeah, but it's going down to then go up on the other side. So all you're passing it is from your right hand to your left hand. But the benefit is that you could have $2,000, $3,000, $4,000, $5,000 of tax savings, depending on your amount of contribution and your cap space and maybe what you have in a 5-year rule. The other thing is, if you make the transition to retirement pension payment, let's say you did it in June and brought your balance under $500,000, that could open up $10,000, $20,000, $30,000, $40,000, $50,000 of space in your cap, depending on what you earn, so that you could then use the legislation in the next financial year because you've brought your balance under $500,000, which then brings in the concessional catch-up legislation, which wouldn't be available if you hadn't used the pension payment in June to bring your balance down to then be strategic for the next financial year.
They do like to make it complicated, don't they?
Oh, look, I think they make it wildly unnecessarily complicated, but I think people also need to not think in a sort of silo-like mentality. It's not up and down, it's left and right, and where can I use this to get myself and my partner and my family in a better position? Because ultimately it's your money and you can use it at any point in time. And there's always an argument, but I haven't retired and the balance is going down. Well, if I can pay part of my mortgage off and I've got a net benefit with no tax coming out of super, I'd much rather do that than pay the same mortgage with after-tax income when I've incurred 30, 34, 39, 49% tax. So again, yes, there's an argument for good and bad on both sides, but I think people need to weigh it up and understand the real benefit of what they're doing, because ultimately superannuation is just capital you can use for any sort of strategy, and a tax benefit and a reduction of non-deductible debt with no tax impost is very, very appealing. And you do a really good job to argue that, well, I'd be better off paying my mortgage off with after-tax income at 39 cents in the dollar, because the math just doesn't work.
Luke Smith from Envision Financial is in the studio with me today, and we're talking about using a transition to retirement to minimise your tax.
Firstly, we want to check and see, well, what sort of contributions am I going to get from my employer this year? Then I'll be looking a little bit further and I'll be thinking about two things. One, do I have any catch-up space? You may not be able to utilise it at the moment because your balance might be 500,000, 520,000, 530,000. But check and see if you've got any space, because as we said before the ad break, it'd make a lot of sense to use the transition to retirement legislation in June, because your measure of availability for the catch-up concessional legislation is the 30th of June. So if you took 10% out of your $520,000 super fund, got it under 500,000, you're now eligible to use that legislation next year, where you may have 20, 30, 40,000 waiting in the wings. So you could put it back in on the 1st of July. You've paid no tax taking it out because you're over 60. You're going to claim a 15% tax deduction putting it in. Now, I'd be thinking about the availability of that catch-up space, even if it's just for 1 year. In our example earlier, $150,000 of wages. If you had a $40,000 deduction, that reduces your taxable income to $110,000. So we're talking several $1,000s of tax benefit. And what have you done? You've taken out 10%, you've opened up another account, you've put it in that account, and you've lodged the form with the ATO. Now, you must lodge a notice of intent. Anytime you put money into super and you want to claim a tax deduction and you're using your own money, not through your employer. So salary sacrifice, you don't have to do this because your employer claims the deduction. But if you've taken out, in our example, 50,000 and you've put in 50,000, you must write to your fund and say, hey, Mr. or Mrs. Super Fund, I've put $50,000 in and I'm going to claim $50,000 as a deduction. And you sign the form and you send it to the fund. The fund will then write back to you and say, hey, Leon, thanks for that. We've processed it correctly. You've got to keep that form, because if you ever get asked to prove that it's been processed correctly, you need to provide the communication to your accountant from the super fund. So keep a copy of the notice of intent, ATO regulated form, downloadable from any website, standard document, all funds will accept it, and then receive the confirmation that they've processed it correctly, because your accountant will want that communication. Think about taking 10% where you're doing it partway through the year, because most super funds will pay out a prorated minimum for the time left to 30 June. Whereas if you take 10% at any time, they will give you that full balance so that you've got control over what you do. Keep in mind that if you start a pension with your entire balance, you will need to give your employer a new superannuation fund to have payments paid into. Or the alternative is leave $6,000 in your account and convert $494,000 as a transition to retirement pension, and you've got your accumulation account open here. One, for employer benefits for simplicity, but two, so that you now have a fund already open that you can put in your $49,000 coming from 10% of $490,000 for something. So get your paperwork right. Do it well before the end of the financial year. Make sure you lodge the notice of intent. Make sure you keep the paperwork, and make sure you understand how your fund wants to receive the money. Some will take it by EFT. Some will want it by BPay. Most of them don't take checks anymore, which isn't a bad thing. But ask, you never know. And I think if people follow those sorts of very simple rules, they'll be able to make sure that they get the best outcome from a tax perspective.
Simple as that. So where can listeners get more information?
Yeah, so office number 62604749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. And we've got the YouTube channel Envision Financial Canberra, where we've got a backlog of all of our shows where you can pause it, watch it on the phone, watch it on the telly. And there's an entire chapter on this exact strategy in Smart Money Strategy, Your Ultimate Guide to Financial Planning, in all good and bad bookstores and online.
Absolutely. And Luke, it's time to say thank you very much for coming in once again.
We'll see you next week.
We'll see you next week. Luke Smith from Envision Financial, back with us again at the same time next Friday afternoon right here on 2CC.